Imagine waking up, checking your brokerage account, and seeing 40% of your savings gone overnight. No warning, no market crash, just an algorithm making a decision that wipes out your hard-earned money. This isn't a story about technology failing, it's about technology being used against you. Today, we're diving into the dark side of AI in finance, where most retail investors lose money without ever realizing what hit them. Let's uncover exactly how the game is rigged and why the odds are stacked against everyday people. Everywhere you look, someone is selling you the dream. AI will make you rich. Passive income with automated trading. Just set it and forget it, and supposedly you'll earn 20% returns while you sleep. It sounds incredible, right? Why wouldn't you want an algorithm to manage your money? It's faster, smarter, and never sleeps. But there's an uncomfortable truth that nobody tells you. The big institutions on Wall Street aren't using AI to help you win. They're using it to beat you. And they've been doing it for years. The game was never fair, but AI has made it even more dangerous for retail investors. Let's start with the most fundamental problem in AI finance, the data itself. Every single AI model is only as good as the data it's trained on. If the data is flawed, so are the results. Financial data is some of the noisiest and most unpredictable data on Earth. Major events like the 2008 financial crisis, the COVID crash, and the 2010 flash crash were all black swan events, completely unpredictable and impossible for any historical data to anticipate. Why do AI models fail to predict market crashes? Because black swan events are anomalies that no historical data could have anticipated. These events are rare, but when they happen, they can wipe out years of gains in a matter of days. AI models trained on past data simply can't see them coming. This means that no matter how advanced your trading bot is, it's still vulnerable to the unexpected, and so is your money. Here's the real danger: overfitting. Imagine an AI model trained on the stock market from 2010 to 2020, one of the longest bull runs in history. It learns that the market always goes up, so it buys aggressively during every dip. But when 2022 hits with inflation and rising interest rates, that same AI keeps buying the dip because that's what worked before. Except this time the market doesn't recover, and you lose your savings. When an AI is optimized for past performance, it's not trading, it's gambling. In this game, the house always wins. Big institutions use AI to maximize their edge, while retail investors are left with tools that are often just gambling with their money. The AI isn't really trading, it's betting on patterns that may not exist anymore, and when things go wrong, it's the retail investor who pays the price. Now let's talk about psychology, because this is where the real danger lies. Humans have a tendency to trust machines more than themselves, a phenomenon called automation bias. Studies show that when people receive advice from an AI system, they're more likely to follow it even if it's clearly wrong. In trading, this means you might follow a bot's advice blindly, believing it's smarter and more objective. But when the system fails, you don't just lose money, you lose trust in your own judgment. When trust in your own judgment is shaken, emotional decisions take over. People panic, sell, double down, or chase losses. It's not just a financial failure, it's a psychological one. The emotional roller coaster of trading with AI can lead to even bigger losses as fear and greed take control. This is the part nobody talks about, but it's crucial to understand if you want to protect yourself. Hedge funds and big banks spend billions on AI infrastructure, faster computers, better data, and more sophisticated models. They have teams of PhDs and computer scientists working around the clock. When you're using a $200 a month trading bot from a startup, you're not competing in the same league. In fact, you're not even playing the same game. Institutions can execute trades in microseconds, faster than your AI can even generate a signal. They can see where retail money is flowing and trade ahead of you. This is called front-running, and it's legal. A 2024 study found that institutional AI systems could predict retail trading patterns with 82% accuracy. That means most retail trades are visible to institutions before they're even executed. You're not trading against the market, you're trading against an invisible force that knows exactly where you're going and is already waiting for you there. In the AI finance game, retail investors aren't players, they're the product. The system is designed to extract value from those who don't have the same tools or information. Let's look at some numbers. A study from Pantera Capital, Stanford University, and IC3 analyzed over 925,000 wallets using AI trading platforms. Users lost a collective $191.7 million, with 62.2% realizing losses. Token prices dropped 93% on average from their all-time highs. Research suggests 87% of retail traders using automated systems lose money within their first year. On platforms like Polymarket, a Bloomberg analysis found that retail investors lost $131 million, not because they were wrong, but because automated bots entered markets early and secured better prices. Humans arrived too late. Even when retail investors predicted outcomes more accurately than bots, they still lost money due to poor execution timing. Joshua Della Vedova, professor at the University of San Diego, explained that retail investors were correct more often than bots, predicting outcomes at 55% accuracy versus 52% for bots. But they still lost tens of millions because they traded late at bad prices. The execution edge is an underrated aspect of trading, and it's where most retail investors fall short. Scariest finding comes from researchers at the Gwangju Institute of Science and Technology in Korea. They put 4 major language models through simulated trading with a negative expected value. When given freedom to determine bet sizes, bankruptcy rates reached up to 48%. The models showed classic addiction patterns: chasing wins, increasing bets after hot streaks, and ignoring probability. Study found that the more you try to optimize your AI trading bot with clever prompts, the more you're programming it to gamble with your money. The correlation between prompt complexity and bankruptcy rate hit 0.991 for some models. These aren't just opinions, these are hard numbers showing how risky AI trading can become. Let's make this real with actual stories. In 2023, a popular AI trading app promised guaranteed 20% annual returns. Thousands of retail investors poured their savings in. The AI was trained on crypto bull market data. When the market turned, the bot kept buying the dip and never recovered. Some investors lost over 60% of their portfolio in less than 90 days. In 2024, a major AI-driven options trading platform had a glitch that triggered thousands of wrong trades in a single hour. Retail investors lost millions. The company blamed a technical error, but the CEO still walked away with a performance bonus. These stories are not rare, they're becoming the norm. In 2025, an AI trading bot on a cryptocurrency exchange promised guaranteed market-beating returns using advanced machine learning. Users lost an estimated $40 million when the AI algorithm collapsed under unexpected market conditions it had never been trained on. $40 million gone in a flash. These stories are not rare, they're becoming the norm, and the people telling them are not the ones who lost money. As AI trading becomes more popular, more retail investors are falling into the same traps, losing money to algorithms they don't understand. Korean researchers also conducted a mechanistic analysis of LLA MA318B using sparse autoencoders. They identified 3,365 internal features that separated bankruptcy decisions from safe stopping choices. This proves that AI models have actual neural circuits for risk-taking and safety, just like a human buying a lottery ticket. The architecture itself showed that models first think about the reward and then consider the risks. This isn't speculation, it's data. It proves that AI models don't truly think, they react. They chase patterns that don't exist, and when real money is on the line, that reaction becomes your loss. So, does this mean you should completely avoid AI in finance? Absolutely not, but you need to play the game smart. There are ways to protect yourself and use AI responsibly. Let's talk about 3 essential rules to keep your money safe. Rule number 1, never trust an AI model you don't understand. If you can't explain how it makes decisions, don't use it. If the platform can't tell you what data it's using, walk away. Transparency isn't optional, it's essential for your financial safety. Rule number 2, always backtest with your own eyes. Even then, start with small amounts. Treat any AI trading tool as experimental capital, not a retirement plan. The goal isn't to get rich quick, it's to avoid losing everything while you're learning. Rule number 3, never let an AI make emotional decisions for you. Your brain still has the best intuition. Trust your gut. If a trade feels wrong, don't do it no matter what the bot says. Sometimes the smartest move in the financial game is knowing when not to play. AI in finance is real, it's powerful, and it has incredible potential. But the way it's being sold to retail investors right now is flawed, dangerous, and sometimes even predatory. The dark side exists, and you need to know it's there to protect yourself. If you've made it this far, you now have a new perspective on AI finance. The reality is that while AI can be a powerful tool, it's not a magic bullet. Understanding the risks and the ways the game is rigged is the first step to playing smart with your money. In the next video, we'll explore how AI can actually help you win the right way. For now, remember, knowledge is your best defense. Stay informed, stay cautious, and never stop questioning the tools you use to manage your money. To sum up, the dark side of AI finance is real and growing. Retail investors face a landscape where algorithms, data, and psychology are all used to tilt the odds against them. But with awareness and smart strategies, you can protect yourself and even find opportunities. The smartest investors are those who stay curious and skeptical. Don't fall for easy promises or flashy marketing. Always do your homework and remember that if something sounds too good to be true, it probably is, especially in the world of AI finance. Transparency is your friend. Only use platforms and tools that clearly explain how their AI works, what data they use, and how decisions are made. If you can't get straight answers, walk away. Your financial safety depends on it. Every loss is a lesson. The stories of failed AI trading bots and lost fortunes are warnings, not just tragedies. Learn from them, use these lessons to build your own strategy and avoid repeating the same mistakes. It's tempting to chase the latest AI trend, especially when everyone seems to be making money. But remember, the hype is often louder than the reality. Stick to proven strategies and don't let FOMO drive your decisions. Regulation in AI finance is still catching up. Many platforms operate in a gray area with little oversight. This means retail investors need to be extra cautious. Don't assume that just because a tool is available, it's safe or fair. Institutions have the resources, data, and speed to win consistently. Retail investors are at a disadvantage not because they're less smart, but because they lack the same tools. Understanding this gap is the first step to leveling the playing field. Timing is everything in trading. Even if you're right about the market direction, being late can cost you dearly. AI bots can execute trades in microseconds, but retail investors often lag behind. Focus on execution, not just prediction. Emotional trading is a recipe for disaster. Whether you're using AI or not, letting fear or greed dictate your moves will almost always end badly. Set clear rules for yourself and stick to them no matter what the algorithm says. AI is a tool, not a magic solution. Use it to enhance your strategy, not replace your judgment. The best results come from combining human intuition with technological power, never from blind trust. The world of AI finance is constantly evolving. Stay curious, keep learning, and adapt your strategies as new information emerges. The more you know, the better equipped you'll be to navigate the risks and opportunities. Don't go it alone. Join communities, share experiences, and learn from others. The collective wisdom of other investors can help you spot red flags and avoid common pitfalls. Together, you're stronger. Before using any AI trading tool, ask tough questions. How does it make decisions? What data does it use? Who benefits if you lose? The more you question, the less likely you are to fall into a trap. No matter how advanced technology gets, your best defense is common sense. Stay grounded, be skeptical of hype, and always prioritize your financial safety over the promise of easy gains. This is the financial game where we play smart with money. The dark side of AI finance is real, but with the right mindset and strategies, you can navigate it safely. Stay tuned for more insights on how to use AI the right way. Thanks for watching. I'm Jack, and this is Financial Game. In the next video, we'll show you how AI can actually help you win if you know the rules. Until then, stay smart, stay safe, and remember, the real edge is knowledge.